Greetings FX traders. Today is Monday, July 2nd. I'm FX with Q. I'm going to give you guys a trading video for this week. So first we're actually going to look at the dollar basket, which is an aggregate of the 7 major pairs, and they're all evenly weighted against the dollar, and this being the first day of the third quarter of the year, we're going to look at the monthly chart to get a big picture. And what I wanted to point out to you guys is we're in this descending trend channel here. There was an important level on this aggregate index that I pointed out that we will, if we do head to the downside in this range, we are going to meet, and we're going to have a bit of a play off of a chance to test this support level that I've identified. The idea is to look left and identify this support level that I've identified. The idea is to look left and identify where the price has come in and interacted and then turn around. So come in and do what options traders would call a touch. So the reason why I'm starting with this chart, the dollar basket here, is that this video is going to be focused on several dollar pairs moving forward. And I also thought it was interesting that we actually have had a bullish cross on the monthly moving average convergence divergence. So you see that in the bottom of the below the price line there. And so the green dot, that represents the bullish cross. Now, this might be a case of indicator whiplash, and I want to go through for you guys what indicator whiplash is, because that's kind of like a jargon term that I essentially made up for trading and responding to signals from indicators that I feel, that they never work 100% of the time. So I'm going to go through what is indicator whiplash. Well, indicator whiplash is, you can, as I was explaining before, you can call it a false positive. The term false positive comes from statistical testing methodology, such as Bayes' theorem uses false positives and false negatives. Now, we don't have to get into the statistics, but really it's just a time when your indicator is wrong. So for a momentum indicator, it's healthy and that there's some momentum, but in fact, when precisely at the moment when the indicator flashed the signal, that's when the price action turns around. And likewise for a reversal indicator, this might be a situation where the trend simply continues and goes past the support or resistance. So traders often call this type of situation a head fake. So now that you kind of have a better idea of what I mean by whiplash, how can we trade whiplash? Well, first of all, you need to have substantial cause to doubt your indicator's signal. So you need to, and we'll talk about that. So your directional opinion needs to be essentially opposite to what the indicator is indicating. Now, this is going to involve both technical and fundamental. So we can start out with looking at fundamental directionality. So, if you're following fundamentals, then you should have a pretty good idea of the themes which have been influencing the pair. And I wouldn't trade a minor theme. I wouldn't doubt my indicator based on a outside theme that maybe not so many people are following or so many people are concerned about. The themes need to be consistent and they need to be well established. So you're going to see commentary in the financial media about these themes, and they're either going to take, they're going to be one of two forms. There's going to be the "See, I told you so," which is essentially like a positive confirmation of the theme's progress, or I understated the importance of X, or the markets are irrationally fixated on X, and which is essentially a misjudgment on the part of the forecaster. And it's okay for forecasters to be wrong. That's the business of forecasting. It involves being wrong quite a lot. So one of the things that you also need to take into account if you are going to get into what I would call a whiplash trade is that you need to have a relative guarantee of quietness and basically like what I call a dearth of recent developments, which means that there isn't a lot coming out. There isn't a lot coming down the pipe. There hasn't been something which has blown up maybe yesterday, and likewise in the next. It depends on your trade frame, but in the next 3 to 5 days, there isn't something looming, because that's going to totally ruin this setup. So looking at the technicals, what we have is struggled by a period of consolidation. So the one thing that you have to look at when you're looking at this consolidation is that the chances for a reversal seem slim. They seem like they're not. It doesn't seem like the market has the price action is indicating really which way it wants to go. The overall impression that you get when you look at the recent price action is indecision. And of course, the two there's really just two names for one pattern here. It's a pennant or a flag, and that's basically these. A flag is a long bull or bear trend that's been consistent, and that's essentially like a flag pole. And then the flag is triangular shaped, so the pennant, and that would be the triangle pattern of consolidation. So one of the things that you're going to have to do if you decide to go the route of what I would call this whiplash trade is you're going to have to narrow the scope of your trade further than what you would usually do with a short to medium term reversal or a short to medium term trend continuation, a momentum trade. So a time frame for your analysis and a shorter time frame for your trade duration, and you're looking at a shorter price range, so you're not risking as much pips in the Y direction, and you're not looking to gain as much. And so this, after you've done that, really what you're looking for is a intraday reversal pattern in the direction of the previous trend. So it's going to be essentially a trend continuation trade. And of course, I know you might be thinking, oh, well, when people buy the dip, say in the S&P 500, that's the classic buy the dip trading psychology. Are they doing this whiplash trade? Well, no, because that's actually a momentum play, a trend continuation play, where I'm defining this as a bit separate in that you're actually willfully shortening your time, trading the inside of the consolidation. So yes, even though your stop loss is tight, make sure that you still maintain the proper risk reward. And I actually really like 2-to-1 risk reward, where I stand to gain twice as many pips as what I'm risking on my stop loss. However, this that means that I'm trading less often. So, looking at an example from last week's trading, in the dollar South African rand, I was presented with this chart on the intraday, and I was thinking to myself, can I make a whiplash play off of this? So just going over the three things that I was explaining before, I was looking for fundamental bias in the opposite direction to the signal. And of course, okay, so we call this whiplash because it's our indicator that got whiplash. So look at that. So we're on the daily chart, and that's the moving average convergence divergence in the middle there, and that's a red dot, which means that there is indeed a bearish cross. It's a signal to sell. But I wanted to trade the opposite of that signal. So what I'm looking for is in the trend starting in February of this year, the long consistent bull trend that's gotten the price up to where it is now. Now, if that were a symmetrical Fibonacci reversal, like an AB equals CD, or if there were some kind of advanced harmonic pattern, a Gartley pattern, a bat, a butterfly. Now, one of the animal patterns, it's inclined to do this type of trade, because long-term technical watchers are going to be seeing that sign of reversal, and the reversal might be committed. It might be sharp. It might be a very dedicated reversal where the bears are going to move in and assert, quickly gain momentum. Now, I'm not as worried about that because of the overall dominance from the bulls that I've seen in 2018. So the fundamental factors, why have the bulls been so dominant? Well, this is actually I've covered this last week's video as well, but I'll just give you guys a quick rundown about South Africa. South Africa is part of the emerging market economy. It's part of the group of countries which we call emerging markets. Now, the pressures which are on broad emerging markets right now are also being felt by South Africa's economy. And these pressures are, I'll just highlight a few. Dollar-funded debt, which is essentially credit with a basis currency in US dollars, is becoming increasingly more expensive to service in South Africa because of the current rate hike regime, which has been the monetary policy of the Fed. The other important factor to consider is just broad risk-off sentiment, which has been into the economy because of factors such as trade war and because of the divergence of monetary policy, again, between the United States and the rest of the world. So this has led to deleveraging of emerging market debt as the reach for yield starts to subside, and traders and institutions look to place their money into safe haven areas. Now, there also is internal political tension in South Africa, which I don't have to go into too deeply. So now, if we go back to my recipe for doing this whiplash trade, the second step after you determined that there was decent fundamental cause and lack of a long-term reversal pattern, what you're looking for now is intraday. You're going to the lower time frame charts, and you're gonna drill down, and you're gonna look for a sign of a reversal on the intraday. So I'm using the same signal that gave me a whiplash on the daily pattern. I'm using this on the 4-hour chart. If you look behind where I've circled, where the bullish cross is, there's actually kind of a harmonic pattern on the intraday where we had good bullish momentum starting in early June, and then there was actually a period of consolidation as the market turned around last week. So how did I frame this trade? How did I decide to put my stop loss? And where did I decide to place my take profit? Well, let's start with the stop loss. The small bull move there, so it's the first orange trend line on the left. That's going to be that's the move that tripped my moving average convergence divergence signal on the 4-hour chart. So what I'm going to do is look for a mirrored move. I'm going to look for the upward direction of an AB equals CD pattern to form. And this mirrored move is all I'm going to ask for the market. I'm not looking to retest highs of the 382 retracement. I'm not looking to go past those highs. So my stop loss has to be tight. Luckily, the way the pattern is shaped, I'm able to put my stop loss in and get a better than 2-to-1 ratio, keeping it tight down there, 0.85% below the previous support. Looking at the follow through of the trade, I was successful with the trade. And if you're going to risk smaller, if you're going to trade for less pips, you actually need to increase your position size usually, unless you're planning on doing a lot more trades. So I was happy to get this profit as I did increase my position size. So I would consider this a successful example of what I would call this whiplash trade setup. So looking forward, one of the main themes which are going to be very dominant in the third quarter of this year are going to be risk themes, and there has been an incredible asset allocation, an incredible concentration of capital in just 4 stocks. So far this year, the first 2 quarters, Microsoft, Amazon, Apple, and Netflix have accounted for 84% of the S&P 500's return. And you can see this is a chart which has been going around. I got it off of Zero Hedge, and then they're getting it from Merrill Lynch. But it's showing your flows, your capital flows, and the tech flows are really a standout. Their overall divergence from the rest in 2018 so far. So among this consolidation in U.S. equities, if we go abroad and we look at the Chinese equity markets, you're not seeing as pretty of a picture. Now, here's the Shanghai Composite Index, and we are well below the 200 moving average, where I believe we just hit 20%, and there was a rally on Friday. This will be a very interesting index to follow in the coming week, as China's currency is looking to be more and more devalued. So JP Morgan's analysis desk had an interesting case, and their case was, is the current downturn in Chinese equities, how analogous is this downturn to the situation in 2015? So for those of you who don't remember what was going on in Chinese equities in 2015, there was a wave of deregulation in 2013, 2014, which drew a lot of new retail traders into the equity markets. And what happened is that retail traders were in positions and levered, and the influx of capital and the influx of leverage created what I would call about a 6-quarter bubble. And in 2015, the bubble popped. So here you can see the outcome of this downturn in Chinese equities. And there's a comparison here between the Shanghai Composite and the S&P 500. Now, if we just focus in on the S&P 500 in 2015, what happened after that crash? Well, during the crash, during the first few months, it was actually a time when the U.S. equities did what a lot of people called the shrug. And so I put this shrug emoji on here so that you guys can kind of visualize this. But it was essentially a couple of pullbacks. But ultimately, as you can see, what happened to the right there is that it ended in a bear trap. There was there was a rally that interrupted what would have been the third pullback. So is JP Morgan right with their analysis, and are we due for another shrug emoji with another bear trap after a few months? Well, maybe not. Things were different in 2015. The macroeconomics was much different. First of all, there was no escalating trade war between China and the United States. In fact, it was looking like TPP, the Trans-Pacific Partnership, had a fairly substantial chance of becoming implemented and ushering in further globalization. Now, interest rates, the monetary policy picture, interest rates were still flat, a much different monetary policy picture down, which is a pretty substantial drawdown in the Shanghai Composite. That was actually coming off of all-time highs. Where's the Shanghai Composite now? Those still were the all-time highs. They're at lower highs now. That's the current drawdown is off of lower highs. So what you're going to want to do is just keep the fragility of the overall situation in mind when you're looking to trade. So if you're looking to go long on the dollar, maybe you shouldn't pick dollar yen just because of the connection between the yen and as a safe haven, as maybe an overall risk off theme starts to bloom in early Q3. So looking at some more dollar pairs that I had highlighted last week, we have dollar CAD, and the dollar CAD shorting like a great picture from a technical basis. In fact, the reversal is really what you want to see when you're trading these harmonic patterns. You want to see a reversal build like that. You want to see a convincing turn to the downside, essentially a bullish engulfing candle, depending on what time frame you're on. This one would probably have to be the weekly. I just want to point out an interesting fundamental picture here for CAD, for the Canadian dollar, and that's its correlation with crude. Now, crude has been on quite a strong rally in 2018. And so here's a comparison of CAD USD, which is the inversion of how the pair is normally expressed. And it's a 60-day rolling correlation coefficient with crude futures. So as you can see right now, crude and CAD have diverged in 2018. And yes, that's because of trade wars. Now, crude's momentum still remains strong. The most recent OPEC meeting was largely a success. There's cohesion among the cartel. Now, CAD does stand to benefit from further increases in crude. Now, if crude does take a quick dive bomb because of developments in that market, then certainly keep an eye on CAD, because CAD could get pulled down with it. As of now, the 60-day rolling correlation is actually very close to zero. Now, things being cyclical, one might expect the correlation to then build again, especially if crude's its strong upward momentum. So going back to trade wars, I talked about this a little bit in last week's video, and how this is the threat of increasing trade wars, trade policy, especially tariffs on Canada, and how that's really just a battle that Canada doesn't want to commit to. Here's a quote from the New York Times. It's Clifford Sosnow, who is a trade lawyer in Ottawa. His opinion is that for Canada to inflict significant economic pain on a neighbor, the United States, about 10 times its size, he compared the upcoming Canada Day tariffs to a pinprick. And this is what Forex traders look for when they look for the influence of fundamentals on currency pairs, we're looking for asymmetry. And so if you read this quote, it's a beautiful depiction of the overall asymmetry in trade and tariff policy between the United States and Canada. Overall, as a fundamental theme, I would say that these trade war developments are going to be bearish for the Canadian dollar. However, this really just depends on the White House. If Trump doesn't escalate the tariff picture, then we could see a recovery for the Canadian dollar as markets essentially say, oh, well, we overpriced that a bit. On the other hand, we still have yet to see the lasting effects of the trade war on things like Canadian employment, Canadian GDP, Canadian manufacturing data. So as these data releases come out in subsequent quarters, that's when we're really going to start to see things sour in Canadian equities, Canadian debt indices, and thus the Canadian currency. So moving on to a pair which I believe doesn't have as great of a technical picture as the previous one, and that's just my opinion, but it has more interesting fundamentals. Here we have the dollar, Japanese yen. So looking at the technical picture, this is really the same one from last week. We had 4 days in a row of increase. We had 4 days in a row of dollar appreciation versus the yen. Now this is actually reversal setup. This is actually a better thing for us now that because we've waited for the price to retest the double top that occurred 2 weeks ago. I still am going to keep a close eye on the overall global risk picture, starting with U.S. equities, as this pair tends to be very responsive to developments in risk assets, and really a relief rally, a strong relief rally from the S&P 500. It's not an outside probability. It's not the most likely probability, but however, it's somewhere in between the two. A relief rally would pin this pair up against the upper descending trend line resistance there, and that's not a situation that we'd probably be looking to get into from the short perspective on dollar yen. Another pair to watch for the same risk-off fundamental themes is going to be the dollar Swiss franc. Now, looking at this big technical picture here of the past 2.5 years, we did have if you look left, we had an interesting period of consolidation starting in the spring of 2016, and I've highlighted this channel with it's kind of this almost sideways movement with black range top and range bottom segments. And all that price action, what that's going to do is that's going to keep, as we move back down into range, that's going to be more chop and more, it's going to make it for a more bumpy ride moving down into the range. Another thing which is going to complicate moving back down into this range is the correlation of the Swiss franc with the euro. And the euro, now a lot of traders, macro traders feel that the euro is due for a rally. I am not committed on one side or the other with the euro, because it's just simply the Italian situation, the situation with Angela Merkel and her upcoming election in October, the overall political situation in Germany, and the situation in EU, the cohesiveness of the EU with the member countries, and moving forward Brexit, there are a lot of complications. So with all of those complications being there, the Swiss franc status as a haven for just looking at the broad long-term picture. So going a bit closer here, this is another reason why I'm a bit hesitant to trade a reversal, a play back into this range. And that's because, as you can see, there's a lack of a retracement on this long extended bull move from early February until May. And I'm looking for more of a reversal setup than that. I'm looking for an animal pattern, advanced harmonic pattern, and AB equals CD. So I'm just about done with this video. Just a quick word of reminder before I go to my conclusion. Don't forget to place your market entries closer to the money, which is closer to where the price is currently when you're trading reversals. So this is the euro pound, and I was trading a play back into range last week, and I had my market entry just outside of the descending trendline resistance. And what had happened was I had it just a few pips north of where the price succinctly turned around. Now, I haven't given up on this reversal play just yet, but I'm not going to get into it now. I'm not going to essentially FOMO in just because my entry missed. What I'd be looking to do would be to trade a double top with the price action coming back up to where my entry is around point D, and then selling from there. So looking at early next week, there actually is quite a bit of data that's slated to be released in the next 24 hours. So just keep an eye on volatility early this Monday, and for quick market moves, as if any of these manufacturing PMIs that are slated to come out end up being very bullish or very bearish for their respective currencies. So overall, next week is very important because it's the start of the third quarter. I'm still expecting the dollar's performance to be mixed. After such a solid bull run in the second quarter of 2018, to see a pure, clean reversal where many of the other majors are all headed in the same. I think that situation is unlikely. I think you're going to see a more mixed setting. You're going to see some pairs do well against the dollar next week, and you're going to see some pairs fare poorly. So with that said, I'll check in with you guys next week. Thank you for watching my video, and good luck trading in the week to come. Good luck trading in the week to come. To come.